Dividend investing. Man, you've probably heard it all, right? The internet is just buzzing with opinions, and it's tough to figure out what's real and what's just, well, hype. So, in this explainer, we're going to cut through all that noise and break it all down. Let's get right into it.
Okay, let's kick things off with the big one, the myth that's just so appealing, the idea that dividends are pretty much free money. That a company just mails you a check as a little bonus just for owning their stock. And then you've got the safety myth. This is that cozy idea that if a stock pays a dividend, it's basically a stamp of approval. It's got to be super stable, almost a guaranteed win. And of course, the classic cage match, dividends versus buybacks. You hear it all the time. Getting that cold, hard cash in your hand has got to be better than a company just buying its own stock back. But, well, it's a little more complicated than that. All right, so let's really get into it. We're going to bust these myths wide open. Because honestly, once you see what's really going on, you'll look at dividend stocks in a whole new light. So back to that first huge myth. If dividends aren't just magic money appearing in your account, where exactly do they come from? Well, the whole secret is wrapped up in something called the ex-dividend date. This date is everything. Think of it as the cutoff. If you own the stock the day before this date, boom, you get the dividend. If you buy it on or after that date, you're out of luck for that payment. Here's the easiest way to think about it. A dividend doesn't create new money out of thin air. All it's doing is moving value around. The company pays you cash from its bank account, right? So the company itself is now worth a little less. And the stock price, well, it has to drop to reflect that. So if you had a stock worth $100 and it pays a $1 dividend, you now have a $99 stock and $1 in cash. Your total net worth? Still $100. Nothing has changed. And that idea leads us right into busting the safety myth. Look, yeah, a lot of dividend stocks are stable companies, but a super high dividend yield, that can be a huge warning sign. Imagine the business is in trouble, so the stock price starts to tank, but they haven't cut the dividend payment yet. All of a sudden, that yield percentage looks amazing on paper, but what it's really screaming is that the market is betting that dividend is about to get slashed. Okay, so what about that big debate? Dividends or buybacks? A dividend, it's simple. You get cash, it feels awesome, but guess what? You usually get taxed on it right away. A buyback is different. The company uses that same cash to buy back its own shares from the market. Fewer shares out there means your slice of the pie gets bigger, which can push the stock price up. And the best part for a lot of people, you don't pay taxes until you actually sell your shares. So which one is better? Honestly, neither one is automatically the winner. It all comes down to the company's specific situation and the smartest way for them to give value back to you. And that brings us to the last myth we're tackling today, the idea that dividend stocks are just boring, that they're for slow, steady income, and you're giving up any real shot at growth. Yeah, not so fast. Let me show you a real-world example. Picture this. You put $100,000 into a classic dividend company, let's say McDonald's, back in the year 2000, and you just let those dividends reinvest automatically. By 2020, that initial investment would have turned into over $1 million. So much for no growth, right? So what was the magic behind that incredible growth? Well, check this out. Sure, the stock price went up, but a whopping 40% of that total return came from reinvesting those dividends. It was the compounding effect, over and over again. Those dividends weren't just a nice little bonus on the side. They were a massive engine driving the whole thing forward. Okay, so we've busted some pretty big myths. Now, let's flip the script. What's the real power of dividends? Why can this be such an effective strategy? For one, dividend payers are often these established, stable companies. Think of a Coca-Cola. They've been around forever. Plus, a steady dividend is a powerful signal. It tells you the company is financially healthy and that management is disciplined. And, during those crazy market swings, getting that cash dividend can be a huge psychological boost. It's a real return, even when stock prices are going nuts. And of course, there's the big one. They can create a reliable stream of passive income. It's like building your own cash flow pipeline. But hey, it's not all rainbows and easy money. To be a smart investor, you've got to see the risks too. You have to know how to spot and avoid the dividend trap. So here's exactly how this trap is set. You have a solid company, trading at $100 a share, paying a normal 4% yield. Everything's good. But then the business hits a rough patch. The stock price drops to, say, $50. All of a sudden, that same dividend now looks like an 8% yield. On paper, it looks incredible, but the risk has just shot through the roof. Then the market starts sniffing out that the company can't afford that dividend anymore. The stock plummets to maybe 25 bucks. Now the yield looks like a mind-blowing 16%. That's the trap. It looks amazing right before that dividend payment gets cut completely.
And that's not the only risk. See, every single dollar a company pays out to you is a dollar it can't use to grow the business, to invest in new products or expand. Taxes can take a bite out of your returns over time. And that false sense of security, it can be dangerous. It might make you hang on to a struggling company way longer than you should have. So, okay, we've gone through the myths, the facts, the pros, the cons, which brings us to the million-dollar question. Should you actually invest in dividend stocks? And look, the only real answer is it depends. There's no magic formula here. It's all about you. What are your goals? What's your timeline? How do you feel when the market gets rocky? Now, with all that said, dividend stocks can be an absolutely fantastic fit for some people, especially if you're looking for that steady cash flow, maybe for retirement or just to have some extra income. They can also add a nice, solid layer of stability to your overall portfolio, since you're often dealing with these big, established businesses. So, at the end of the day, it's really about a shift in how you think about it. The question isn't just which stocks pay a high dividend. The real question you should be asking is this: which companies are so good, so profitable, that they have truly earned the right to pay you a piece of their profits? When you start there,